Bank of Singapore is a locally incorporated bank in India. This after RBI granted it the license to operate as a wholly owned subsidiary. Now, the Singapore-based lender has become the second such foreign bank to follow this model after State Bank of Mauritius. Remember, the wholly owned subsidiary route allows foreign lenders to be treated as a local bank, removing certain restrictions that they face, such as those on opening new branches. To discuss DBS's India strategy, I am now joined by Surajit Shom, the CEO, DBS Bank India. Mr. Shom, thank you very much for joining us on CNBC TV 18. First up, how bullish are you on your growth in India? I mean, we know it is a huge market. The banking sector penetration remains low. We keep hearing that from all the lenders here. But you're coming in at a time when the financial sector is also going through a very tough phase. Tell us what your strategy is going to be.
Thank you very much. So I think your question actually has part of the answer. We think it's an opportune time for us. As you know, over the last 3-4 years, we've been waiting to convert into a wholly owned subsidiary, which we completed, as you rightly said, on 1st of March, which allows us to now branch freely. But we think that the opportunity today is quite unique for 3 reasons. One, consumer preferences in the financial services sector is changing quite rapidly because of how much digitization that is going through, as well as the capability of the banks. The banks themselves are changing the way they offer services to their consumers. And we think as DBS, we've made some significant strides that's also recognized by the external world, as in the last 3 years, we've been rated as the best digital bank in the world. So we think that we can bring that capability, which we introduced into India 2.5 years back through the launch of DigiBank. We have over 2.5 million customers already. And with the conversion, we can now add a strong physical network expansion, which strengthens our, if you will, physical plus digital strategy, which was our primary route to growing a business in India.
So, in India, your lending currently is highly skewed towards corporate loans, which I understand is almost 70% of the book. And it is quite inconsistent with your profile in other parts of the world. Now that you have this license, how will the ratio change?
So you're absolutely right. This is our 25th year in India. And we built for the last, I would say, 15-20 years of our journey, an essentially large and mid-corporate business with the limited presence that we had. We had only 12 branches in 12 cities, and the number you said is correct. We have a skew in favor of large corporates. Our goal over the next 3 years to take this to roughly around a 40-30-30, 40% large and medium corporates, 30% SMEs, and 30% in the consumer sector.
All right, since you said you want to devote 40 to 30% to retail and SME, that lending in that segment is highly correlated with the GDP cycles. Right now, India does remain one of the fastest growing economies, but the latest GDP figures have been a tad disappointing. It's at a 5-year low, actually. So what growth are you initially targeting given the current macro scenarios in India?
So it's interesting you make that comment, because as we speak to our SME customers, we see them being actually quite bullish, because we do believe that parts of the manufacturing sector definitely are showing signs of revival. And we think there are opportunities in the manufacturing sector. We also see opportunities in the services sector. Again, we do not have to, because the market is large, we do not have to always depend on the overall market expansion for us to build a profitable share, because we think that there has also been a lot of dislocation because of the capital shortages in some of the banks, the traditional banks, as well as what has happened over the last 3-4 months on the NBFC sector. So we think there is enough space for a player like us to build a robust underwriting which is based on data as well as technology, and which can be a profitable business, given where we are in terms of our relative size to the overall market.
All right, so what will be your expansion strategy? You currently have 12 branches. Where do you see that expanding to, say, by the end of the current year and then thereafter?
So Yeah, so over the next 12 months, we will go to 25 cities and with more than 100 touch points. In fact, in the month of March, we are adding 9 new cities and 5 new centers, which are unbanked rural centers. So we will more than double our network in the month of March. And by the end of the year, we expect to be over 100 touch points. I say touch points because about a year and a half back, RBI liberalized the way a locally incorporated bank could expand. So we'll use all the formats, that's branch, digital kiosks, as well as manned ATMs, to build the relevant footprint depending on where our customers are clustered.
Okay, how has the bank's asset quality been in India, given that you have a large exposure in corporate, also to many of the IBC cases that are currently undergoing proceedings where recoveries have been poor? I understand you've also, stepped up your provisioning in these. Could you give us some sense of what you're expecting from here?
Yeah, so like many other banks, we also took our hits in the mid and large corporates, especially in the infrastructure sectors. And I'm happy to report that this year, when we close our books, we expect our net NPAs to be less than 0.4% and our coverage ratio to be above 90%. This has dropped dramatically over the last 3-4 years as we've spent a lot of time both cleaning up our balance sheet, but also disposing of and recovering many of the problem loans, including the cases that have gone into IBC as well as NCLT and NCLAT.
Could you give us a target, Mr. Shom? Where do you see your NPL levels stabilizing at? What kind of growth should we expect in the next 1 year?
So I think we don't expect our net NPAs to grow from here on. We've had very few new NPAs in the last 24-36 months. We have basically dealt with our legacy portfolio. So as I said, our net NPAs are actually only 0.4%. So from here on, we think that they will stay well below 1% over the next 12 months, if that's what you're looking for. And we really haven't seen any flow through in the last 2-3 years.
All right, Mr. Shom, thank you very much for your time and appreciate you joining us here on CNBC TV 18.
Thank you.
On
very
that
much.
note,